In this video, we're going to walk through the calculation of market share and industry volume variances. We can use market share variances to evaluate our marketing performance. The industry volume variance is the portion of our sales activity variance that's due to changes in the overall industry volume. For instance, in recent years, the sale of DVDs has been declining industry-wide. With the COVID-19 epidemic, sales at restaurants have been declining, while the volume of sales for toilet paper and disinfectants has been rising significantly. The volume industry variance will isolate the change in our sales activity related to overall changes in industry activity. Then the other portion of our sales activity variance is due to our market share variance. It's due to changes in the company's proportion of sales in those markets in which we operate. In other words, has our share of that industry volume gone up or gone down? Let's return to an example from Chapter 16. In Chapter 16, our Introduction to Variances, we had determined we had a sales activity variance of 20,000 units. We had a revenue activity variance of 200,000 and a contribution margin activity variance of 106. And again, the activity variance is simply the difference between our original master budget and our flexible budget. And again, that flexible budget is how much would we expect it to cost us to produce and sell the 80,000 units that we actually sold. Let's go ahead and walk through our calculation of market share and industry volume variances. Now, we would be given the information in this blue field in a problem. I've just assumed that. I've assumed that we had an overall estimated industry volume of 400,000 units, and we had a 25% expected share of that, and that's where we got our original budget amount of 100,000 units. Our actual level of sales, recall, turned out to be 80,000 units. And the actual level of the size of the industry market we've assumed, again, this would be given, was 500,000 units, which means we had a 16% share. In the center column, we will calculate the number of units we would have expected to sell if the industry volume was indeed the 500,000 it actually was, and we had maintained our expected 25% market share. That would have been 125,000 units. So overall, our total sales activity variance in terms of units was 20,000 units, and it was unfavorable. Again, that's because originally we had budgeted 100,000 units. We only sold 80,000 units. Our market share variance is 45,000 units, and that's unfavorable. And that's basically the 9% difference in market share. Our market share declined from 25% as our expected amount down to 16. So the 9% times the actual industry volume of 500,000. And of course, it's unfavorable because our market share decreased. The volume variance is 25,000 favorable. And that's the overall 100,000 unit increase in the overall market size. Again, we had expected the industry volume to be 400. It turned out it was 500,000. So $100,000 difference, or 100,000 unit difference, and our share of that we expected to be 25%. And of course, we notice our 45,000 unfavorable market share variance and a 25,000 favorable volume variance sums up to our overall activity variance, which was 2,000 units unfavorable. Once we've calculated our volume variance and market share variance in terms of units, it's very easy to break down the sales revenue as well as the contribution margin. We simply take the amounts we've calculated for our market share, volume, and activity variance in units and multiply those by our budgeted selling price or our budgeted contribution margin. In this problem, recall, our estimated selling price was if we take our 800 divided by 80, was $10 per unit. Our estimated contribution margin per unit was the 424 divided by the 80 was $5.30 per unit. So to get our sales market share our market share variance in terms of sales revenue, we simply take the 45,000 units and multiply it by our $10 per unit selling price. To get the volume variance, we take the 25,000 favorable variance and multiply it by $10 per unit. And of course, the activity variance is the 20,000 units multiplied by $10 per unit. To calculate our market share and volume variances in terms of our contribution margin, we simply take the per unit amounts we've calculated and multiply it by our standard contribution margin of $5.30 per unit. These are actually the answers that Connect is looking for in most of their problems. So our market share variance would have been 238,500 unfavorable. Our industry volume variance would have been 132,500 favorable. And our combined or overall activity variance was $106,000 unfavorable. And that's what we saw on our sales flexible budget report right here. Let's walk through another problem. We're going to walk through problem 1723. DB Ice Cream budgeted sales of 50,000 gallons of flavor C, clever marketing, assuming the company would have 20% of a 250 gallons market size. The actual results were 45,000 gallons based on a 15% share of a 300 gallon market. We're told the budgeted selling price is $4 per gallon and our contribution margin is $2 per gallon. We need to compute the sales activity variance and break it down into market share in industry and volume variances. First, we'll do it in terms of units, and then we will multiply by the selling price to get our variances in terms of selling price, or multiply the unit amounts by the contribution margin to get our contribution margin variances, which is what Excel is looking for in terms of answers. Let's begin by completing our center column. Our expected market share again was 20%. That was given. The actual market share was 300,000, and had we gotten 20% of the actual markets, we would have expected to sell 60,000 gallons. And again, we only sold 45,000 gallons, so we have an unfavorable 15,000 gallon market share variance. Our volume variance is 10,000 and it's favorable. And again, the volume variance is favorable because the actual industry volume of 300,000 gallons was higher than our expected industry volume of 250,000 gallons. We can combine the two and we get a 5,000 unfavorable overall activity variance. And again, that's the difference between our original budget of 50,000 units and we sold 45,000 units. Now, to get our sales revenue activity variances, we simply multiply our unit amounts by our $4 per unit selling price, and we get a market share variance of 60,000 unfavorable. We multiply the 10,000 units by $4 and we get a 40,000 favorable volume variance. And of course, the two combined gives us a $20,000 unfavorable activity variance, and that would have been our 5,000 units at $4 per unit. Finally, to get the answers that Connect is looking for, because they're always looking for our contribution margin, market share, volume, and activity variances, we again simply take the unit amounts we've calculated and multiply them by our, in this case, $2 per gallon contribution margin. So our market share variance is 15,000 gallons times $2 per gallon, or 30,000, and it was unfavorable. Our industry volume variance was the 10,000 units multiplied by $2 per unit, 20,000, and it is favorable. And of course, the two combined to give us our overall activity variance of $10,000.